How will unprecedented monetary interventions impact the economy long-term? Imagine a central bank stepping in with actions never seen before. These moves can shake up the economy in ways that last 4 years. When central banks buy large amounts of government securities or lower interest rates to levels not used before, they are making unprecedented monetary interventions. These are usually done during times of crisis, like a financial downturn or a global pandemic, to keep the economy afloat. In the short term, these interventions can stabilize markets and prevent a collapse. They help keep credit flowing and support businesses and families. But what happens after these measures are in place for a while? Long-term effects can be quite different. For example, injecting a lot of money into the economy can lead to higher inflation. When more money chases the same amount of goods and services, prices tend to rise. If inflation gets out of control, it can erode purchasing power and create economic instability. Another long-term impact is on government debt. When central banks buy government securities, they are effectively financing government spending. This can lead to higher public debt levels over time. While this can be helpful in the short run, it might cause issues later if debt becomes too high to manage comfortably. Interest rates are also affected. Central banks might keep rates very low for a long time to support growth, but eventually, they may need to raise them to control inflation. Higher interest rates mean borrowing becomes more expensive for consumers and businesses, which can slow down economic growth. Asset prices like stocks and real estate often increase when central banks buy securities and keep borrowing costs low. While this can boost wealth for some, it can also create bubbles that might burst later, causing financial instability. There are also risks like economies becoming too dependent on central bank support. If markets expect constant intervention, they might not function properly without it. Additionally, these policies can sometimes widen income gaps, benefiting those who own assets more than those who do not. Understanding these long-term effects helps policymakers strike a balance. They need to support economic recovery without creating bigger problems down the road. Managing these interventions carefully is key to ensuring sustainable growth and stability. While they can provide immediate relief, their long-term impacts requiring constant attention and adjustment.